Most traders come into the market with the same silent expectation that today will be the day they finally catch the big move, the surge, the breakout that changes everything. They sit in front of their screens chasing numbers, signals, and impulses, believing that if they can just capture enough profit, they will somehow arrive at mastery. But this mindset is the very obstacle that keeps them trapped in an endless cycle of frustration. The truth is simple, yet difficult for most to accept. The market does not reward those who chase profits. It rewards those who can execute one good trade at a time with absolute clarity, precision, and emotional neutrality. A good trade is not defined by the outcome. It's defined by the quality of the decision you make before you ever click the button. When you shift your focus from how much can I make to how well can I execute, you immediately step into a completely different mental space. In this space, fear loses its grip, greed loses its influence, and uncertainty stops feeling like a threat. Instead, it becomes part of the environment you operate in. No different than weather conditions a pilot accounts for when flying. The market stops being a battlefield and becomes a field of probabilities. Neutral, impersonal, and always presenting opportunities. The shift begins the moment you stop measuring your success by the size of your wins and start measuring by the consistency of your process. Every trader has had days where they make money by accident and lose money with perfect analysis. This inconsistency confuses them and pushes them deeper into emotional trading. They start forcing trades, taking setups that don't exist, and reacting to the market instead of responding to it. But the trader who prioritizes one good trade doesn't fall into this trap because their sense of identity and confidence isn't attached to the market's short-term feedback. Their entire mission becomes protecting their edge, following their rules, and executing with discipline. One good trade becomes the foundation for the next one, and then the next, and then the next. When your mind learns to focus on execution instead of outcome, you build a psychological structure that is stable, resilient, and calm under pressure. The chaos of the market no longer disrupts you, it simply becomes the backdrop against which you perform. You stop thinking about the money you want to make this week or this month because you understand that the money is a byproduct of doing the right thing repeatedly. Chasing profits puts you in a constant state of reaction, but making one good trade at a time puts you in a state of control. It turns trading from a desperate hunt into a deliberate practice. It transforms emotional decisions into structured ones. And most importantly, it teaches you that mastery does not come from intensity, it comes from consistency. The single most transformative shift a trader can make in their approach to the market is moving from a mindset of chasing profits to a mindset of focusing on executing one high-quality trade at a time. Chasing profits is a natural human inclination. When people see money on the table, the mind reacts with desire, urgency, and sometimes panic. In trading, these emotions are amplified. A trader watching a chart, seeing prices moving quickly, often experiences a combination of excitement and anxiety, both of which can cloud judgment. The desire to make money can become so overwhelming that it overrides the disciplined strategies and risk controls they have carefully planned. In contrast, focusing on executing one good trade requires a complete mental reorientation. The emphasis shifts from the outcome, the money, to the decision-making process itself. This distinction is subtle but monumental. It is the difference between playing the market reactively and operating within it proactively. A high-quality trade is defined not by the size of the profit it might generate, but by the quality of the reasoning, the adherence to rules, and the clarity of the entry and exit decisions. It begins long before any position is taken, rooted in preparation, observation, and understanding of the market environment. The trader examines patterns, market behavior, volatility, and risk-to-reward ratios. Every detail of the setup is considered. The timing of entry is scrutinized. Position size is carefully calculated relative to the risk allowed. Stop-loss levels are not arbitrary, they are logical, based on market structure and price behavior. In this way, the trader creates a scenario in which the trade is a calculated, disciplined decision rather than a gamble driven by hope or fear. The focus is entirely on executing the plan with precision without concern for what the market might do beyond the limits of the trade setup. Chasing profits, by contrast, is driven by the mind's need for validation. A trader who chases profits is unconsciously seeking approval from external results. The market becomes a scoreboard rather than a system to interact with. This approach fosters impatience, impulsiveness, and overtrading. When a trade does not move in the expected direction quickly, the trader reacts emotionally, often abandoning rules, moving stop levels inappropriately, or forcing trades that don't meet the criteria. The consequences are predictable. Losses accumulate, confidence erodes, and the trader begins a cycle of chasing even harder to compensate for prior mistakes. The irony is that the more a trader chases profits, the further they move from the conditions necessary for consistent high-quality trades. Emotional decisions replace disciplined planning, and the trader becomes subject to the whims of the market rather than a participant within a structured framework. Focusing on one good trade at a time also builds psychological resilience. The trader learns to detach from immediate outcomes because the definition of success is internal. A successful trade is one executed correctly according to rules, not one that necessarily makes a large profit. This internal measure of success eliminates much of the anxiety associated with trading. The trader's confidence comes from adherence to a repeatable process, not from momentary wins. When a trade loses, it is not seen as a personal failure. It is simply an outcome that falls within the expected probabilities of the market. This perspective allows the trader to maintain composure, to stay within the plan, and to continue executing trades with clarity rather than with desperation or frustration. Discipline becomes the natural companion of focusing on high-quality trades. To execute well, the trader must control impulses, follow rules consistently, and respect risk parameters. Every decision is examined. Does this trade meet the pre-established criteria? Is the timing correct? Are the risk and reward acceptable? These questions require calm, analytical thought, which is incompatible with emotional reactions driven by the desire for quick profits. Over time, this repeated practice trains the mind to value process over outcome, to see market movements as information rather than threats or opportunities to satisfy greed, and to respond rationally rather than reactively. The discipline developed through this approach extends beyond individual trades, shaping the trader's entire approach to markets and decisions. Patience is another key aspect of executing one high-quality trade. The trader learns to wait for the setup that aligns perfectly with their criteria rather than forcing trades out of boredom or urgency. Markets are inherently probabilistic. No setup guarantees a win. Understanding this allows the trader to avoid frustration when trades do not immediately present themselves. Each moment spent waiting is a moment of preparation, observation, and refinement of strategy. The trader's attention remains on the process, on the conditions that increase the probability of success, rather than on immediate gratification. Patience, combined with discipline, ensures that when a trade is finally executed, it is not only well planned but also emotionally supported by confidence in the process. Executing one good trade at a time also enhances learning and self-awareness. Each trade becomes a data point, an opportunity to assess decision-making, risk management, and emotional responses. The trader can review why a trade was entered, how it was managed, and what could be improved. Over time, this feedback loop creates a level of self-knowledge and market understanding that chasing profits can never provide. The trader begins to recognize patterns in their own behavior, identify weaknesses, and strengthen strengths. Emotional reactions are no longer surprises, but expected variables that can be managed. This continuous improvement fosters mastery not through luck or intuition alone, but through deliberate practice, reflection, and adaptation. In focusing on one high-quality trade, the trader begins to see the market not as a series of random events to exploit, but as a structured environment governed by probabilities. Every trade is an experiment within the framework of the market's logic. Outcomes vary, but the quality of decision-making remains consistent. The emphasis on execution creates a sense of control, even when the market is volatile, because the trader knows they are acting within a disciplined system rather than reacting to external noise. Chasing profits, by contrast, leaves the trader at the mercy of unpredictability, always striving for results that are often beyond control. By anchoring success in process rather than outcome, the trader develops a mindset that is calm, focused, and capable of sustained performance. In trading, one of the most common misconceptions is that success is determined by how much money is made on a trade or over a certain period of time. This belief is deeply ingrained in the minds of many traders who equate their self-worth, skill, or intelligence with the results displayed on their account statements. The problem with this way of thinking is that the market is inherently uncertain and outcomes are influenced by variables that are often beyond a trader's control. A single trade can be profitable due to luck or timing, while another trade executed perfectly according to a well-developed plan can result in a loss because of market conditions that were impossible to predict. When traders tie their sense of success to these outcomes, they set themselves up for a roller coaster of emotions. Exhilaration when trades go well, despair when they do not. This emotional volatility is a major barrier to consistent performance. By shifting the focus from outcomes to the process, a trader gains control over what is within their power and becomes capable of achieving long-term success in the markets. Process consistency means adhering to a clearly defined set of rules, strategies, and risk management principles in every trade without deviation. It is a commitment to doing the right things repeatedly, regardless of what the market does or how the individual trades turn out. This consistency is the foundation for measurable improvement because it allows the trader to isolate variables, understand what works, and refine their approach. For example, if a trader has a strategy that identifies certain patterns with a high probability of success, executing trades consistently according to that strategy will over time generate predictable results. Random deviations, impulsive decisions, or chasing trades because of fear or greed distort the process and make it impossible to accurately assess performance. In essence, it is not the profit or loss of a single trade that defines success, but the discipline to follow a repeatable process that is aligned with probability and risk control. Focusing on process consistency also addresses the emotional side of trading. When outcomes are unpredictable and traders are emotionally attached to results, they are prone to overreacting to wins and losses alike. A profitable trade may encourage overconfidence, leading to reckless behavior, while a losing trade may induce fear or hesitation that prevents the trader from taking good opportunities in the future. By shifting attention to the process, traders learn to view each trade as an independent event and as a chance to execute their plan correctly. The emotional highs and lows diminish because success is no longer defined by money made in a single trade or day. Instead, it is measured by whether the trader followed the rules, respected risk management, and executed decisions according to a proven methodology. This creates a stable mental framework that allows traders to perform at a high level over time. Consistency in process also enables a trader to accurately evaluate and improve their trading. When each trade is executed according to a defined strategy, the outcomes become meaningful data points. A trader can analyze these trades to understand what is working and what is not. Patterns of errors, tendencies to deviate from the rules, or emotional triggers that affect decision-making can be identified and corrected. Without process consistency, however, performance data is chaotic and unreliable. Wins and losses appear random, and the trader cannot separate skill from luck. Over time, focusing on the process rather than outcomes allows for continuous improvement because each trade becomes an experiment, an opportunity to refine skills, and a step toward mastery. This approach transforms trading from a game of chance into a disciplined practice grounded in probability, logic, and self-awareness. Another critical aspect of measuring success by process rather than outcomes is the development of patience. The market does not always present ideal opportunities, and a trader who is outcome-driven is more likely to force trades in order to generate profits. These forced trades are often low quality, carry excessive risk, and undermine long-term performance. Traders who focus on process consistency understand that not every moment in the market is a trading opportunity. They learn to wait for setups that meet their criteria, to act only when the probabilities are favorable, and to maintain discipline even when the market is moving rapidly. Patience, reinforced by a commitment to process, prevents impulsive decisions and protects the trader from the emotional swings caused by short-term results. Risk management is also inseparable from process consistency. Each trade carries inherent risk, and the outcomes cannot be guaranteed. By following a consistent risk management plan, defining position size, setting stop-loss levels, and calculating acceptable loss relative to the account, traders protect themselves from catastrophic outcomes and maintain the ability to trade another day. This reinforces the principle that success is not about individual wins or losses, but about surviving and thriving in the market over the long term. When the process is consistent, risk is controlled, and the trader's account becomes a reflection of disciplined practice rather than chance. Over time, this leads to cumulative success that is sustainable and predictable. rather than the highs and lows of outcome-focused trading. Focusing on process consistency also enhances mental clarity and confidence. Traders who measure success by their adherence to rules and execution quality experience less stress, less doubt, and less frustration. They know that even if a trade loses, the decision was made correctly and the outcome is part of the probabilistic nature of markets. This mindset reduces second-guessing, eliminates reactive behavior, and allows the trader to remain calm and focused. As the habit of process consistency strengthens, the trader begins to trust themselves, their strategy, and their ability to navigate uncertainty. Confidence is no longer dependent on external validation from profits, but is derived internally from competence and discipline. Trading is one of the few human endeavors where emotions can directly determine outcomes in a measurable way. Unlike many professions, where skill, knowledge, or effort primarily dictate results in trading, a person's emotional state can override strategy, experience, and logic. The markets operate on probabilities, not certainties, and they offer no guarantees. This reality makes emotional neutrality not just a desirable trait, but an essential requirement for consistent, disciplined performance. Emotional neutrality means that a trader is neither elated by wins nor devastated by losses. It means approaching each trade with a calm, objective mindset that allows decisions to be based on rules, analysis, and probability rather than impulse, fear, or greed. Without this level of control, even the best strategies and analyses can be rendered ineffective. Emotional reactions are natural. The human brain is wired to respond to threats and rewards with intense feelings. Fear triggers hesitation, overcaution, or outright avoidance, while greed can push a trader to chase opportunities that are not aligned with their strategy. Both emotions distort perception. Fear can make small risks seem enormous, causing traders to exit trades prematurely or miss good opportunities. Greed, on the other hand, can inflate expectations, encourage over-leveraging, and provoke impulsive entries that violate the trader's rules. When a trader allows emotions to dominate, decisions become reactive, situational, and inconsistent. The market does not forgive emotional trading. One impulsive move can wipe out days, weeks, or even months of disciplined effort, reinforcing the notion that emotional neutrality is not optional, but foundational to trading success. Achieving emotional neutrality begins with understanding the role of probabilities in trading. No trade, regardless of how carefully planned, can be predicted with certainty. Losses are inevitable, and they are not indicators of personal failure. Emotional neutrality develops when a trader internalizes this truth. Each trade is viewed as one instance within a larger statistical framework. Some trades will win, some will lose, but over a series of trades executed according to rules and risk management, the results will reflect the trader's skill and process, not luck alone. By focusing on probability rather than outcome, the emotional intensity associated with each trade is diminished. The trader becomes a participant in a structured system rather than a victim of unpredictable market movements, allowing for rational decision-making even during high-pressure situations. Another critical aspect of emotional neutrality is the ability to detach self-worth from trading outcomes. Many traders measure their value, competence, or intelligence based on the profits or losses they realize, which creates a direct connection between external results and internal emotional states. This connection is destructive because outcomes are not fully within the trader's control. Emotional neutrality requires recognizing that a losing trade does not define ability, and a winning trade does not validate skill beyond the quality of the decision-making process. Detaching self-worth from outcomes allows the trader to focus entirely on executing trades correctly, evaluating opportunities objectively, and learning from experiences without ego interference. The mind becomes a tool for observation and action, not a battlefield of conflicting feelings. Emotional neutrality also enhances consistency in execution. Discipline in trading is a direct function of emotional control. When emotions are in play, the trader is more likely to deviate from rules, overtrade, or abandon strategies that have proven successful over time. Emotional impulses introduce variability that masks skill and prevents reliable performance measurement. Neutrality removes this variability. The trader follows the plan, respects position sizing and risk limits, and executes entries and exits according to predefined criteria. In this state, mistakes are not the result of lack of skill, but are opportunities to observe, analyze, and refine the approach. Emotional neutrality transforms errors from personal failures into instructive experiences, which is essential for growth and improvement in a probabilistic environment like trading. Patience is another byproduct of emotional neutrality. Waiting for the right setup rather than forcing trades based on desire, fear, or expectation is a hallmark of disciplined traders. Emotional traders feel compelled to act when the market moves, even if conditions do not meet their criteria. Neutrality allows the trader to observe and wait, to act only when probabilities align with strategy, and to maintain calm when the market is moving rapidly. This patience is directly tied to long-term profitability because it prevents impulsive decisions, protects capital, and ensures that only high-probability trades are executed. Emotional neutrality and patience are intertwined, creating a feedback loop that strengthens discipline and reduces the mental noise that often sabotages performance. Self-awareness plays a central role in cultivating emotional neutrality. Traders must constantly observe their internal state, recognizing when fear, greed, or excitement begins to influence decisions. This requires honest reflection and the ability to pause before acting. Techniques such as journaling, mindfulness, and pre-trade routines help traders identify emotional triggers and develop strategies to manage them. By becoming aware of the emotional tendencies that affect behavior, traders can implement rules or systems that mitigate impulsive actions. Over time, this self-awareness allows emotional neutrality to become a habit rather than a conscious effort, creating a mental framework where disciplined execution is automatic and consistent. Risk management and emotional neutrality are inseparable. Understanding that every trade carries risk allows the trader to set realistic expectations and avoid the emotional extremes associated with uncertainty. By defining stop-loss levels, position sizing, and maximum acceptable losses in advance, traders remove much of the emotional reaction from the equation. When a trade reaches its stop, it is not a personal failure, but the result of a well-planned decision executed according to rules. Emotional neutrality is reinforced because the trader is prepared for any outcome, and the focus remains on adherence to process rather than reaction to results. This preparation transforms trading from a game of chance influenced by mood swings into a disciplined practice governed by probability and rational decision-making. Finally, emotional neutrality enhances learning and continuous improvement. By removing emotion from the evaluation of trades, traders can objectively review what worked, what didn't, and why. Patterns of decision-making, deviations from rules, and cognitive biases can be identified and corrected. Each trade becomes a source of insight rather than a trigger for stress or euphoria. Emotional neutrality allows the trader to absorb lessons without ego interference, leading to progressive refinement of strategy, improved risk management, and heightened psychological resilience. Over time, this state of calm and objectivity enables the trader to operate at peak efficiency, execute trades with precision, and navigate the inherent uncertainties of the market with confidence. Every trader eventually comes to realize that trading is not a series of isolated events, but a continuous process in which each decision lays the groundwork for the next. This concept is simple in theory, but difficult to internalize, especially for traders who are outcome-driven or emotionally reactive. Most people enter the market with the belief that each trade is a chance to win or lose in a vacuum, and they fail to recognize the cumulative effect of disciplined execution. In reality, trading is a chain where each good trade, executed with precision, adherence to strategy, and emotional neutrality, creates a foundation of confidence, understanding, and psychological resilience that directly enhances the quality of the trades that follow. This perspective transforms trading from a sporadic endeavor into a continuous, self-reinforcing process of learning and improvement. A good trade is defined not solely by the profit it generates, but by the quality of the decision behind it. This includes the clarity of the entry, the appropriateness of risk management, the alignment with strategy, and the level of discipline in execution. When a trader consistently executes trades that meet these criteria, they are essentially building blocks for future performance. Each trade becomes an experience that reinforces correct behavior and strengthens the decision-making framework. By contrast, trades driven by emotion, impatience, or overconfidence create weak foundations, introducing patterns of inconsistency that undermine the ability to perform effectively over time. Understanding that every trade contributes to the next shifts the focus from chasing immediate results to building long-term competence. The psychological impact of each good trade is profound. Confidence in trading is not the product of a single big win, but the accumulation of numerous trades executed correctly, regardless of outcome. When a trader enters a trade according to plan, follows rules for risk management, and maintains emotional neutrality, they reinforce trust in their own abilities. This internal trust is critical because the market is unpredictable, and there will always be losses. Confidence derived from process rather than outcome allows the trader to approach subsequent trades without hesitation, fear, or overcompensation. Over time, this cumulative confidence reduces the likelihood of impulsive decisions, strengthens discipline, and fosters a mindset capable of handling the inherent uncertainties of the market. Each trade also provides valuable feedback, both about the market and about the trader. When executed correctly, a trade becomes a data point that can be analyzed objectively. The trader can assess whether the strategy is effective, whether risk was properly managed, and whether emotional reactions were controlled. This feedback loop creates a cycle of learning that compounds over time. Mistakes can be identified and corrected, successful patterns can be reinforced, and psychological weaknesses can be addressed. A trader who understands that each trade is part of a cumulative process does not see a loss as a failure, but as information that contributes to future improvement. In this sense, every trade, good or bad, is a stepping stone toward greater skill as long as it is approached with discipline and reflection. Consistency in building upon each trade also enhances the trader's ability to manage risk. Risk is a constant in the market, and its effective management depends on discipline and foresight. A good trade executed today ensures that capital is preserved and available for tomorrow's opportunities. By adhering to risk parameters, respecting stop losses, and sizing positions appropriately, the trader avoids catastrophic outcomes that could compromise the ability to participate in future trades. This cumulative approach to risk management reinforces the concept that each trade is a building block. A single poorly managed trade can compromise the foundation, but a series of well-executed trades creates resilience and capacity for sustained participation in the market. The foundation-building effect of each good trade also extends to the development of mental clarity and emotional stability. When trades are executed in alignment with a plan, the trader learns to separate decisions from emotions. The repetitive practice of disciplined trading strengthens focus, reduces impulsivity, and fosters a calm mindset. This calm, in turn, enhances the quality of subsequent trades because the trader is not reacting to past mistakes or chasing unrealized profits. Instead, they are present in the moment, fully engaged with the conditions of the market, and capable of executing decisions with precision. Each disciplined trade strengthens this mental framework, creating a positive feedback loop in which psychological stability and decision quality reinforce one another. Another critical aspect of this principle is the development of pattern recognition. Markets are probabilistic, and understanding the recurring behaviors and structures is essential for consistent success. Each high-quality trade contributes to the trader's ability to recognize patterns, anticipate market movements, and refine entry and exit strategies. By focusing on process rather than outcome, traders build a mental library of scenarios that can be referenced in future trades. This accumulation of knowledge is a direct result of treating each trade as a foundation. With time, the trader's decision-making becomes faster, more intuitive, and more aligned with probabilities, because each prior trade has contributed to a growing understanding of the market environment. The cumulative effect of good trades also fosters resilience in the face of inevitable losses. Losses are an integral part of trading, and even the best traders experience them. When each trade is viewed as a building block, losses are contextualized as temporary setbacks rather than catastrophic failures. The foundation built by prior disciplined trades ensures that a single loss does not destabilize the trader psychologically or financially. This perspective allows the trader to recover quickly, maintain confidence, and continue executing future trades with clarity. Over time, this resilience becomes a defining characteristic of successful trading because the ability to persist and execute consistently is far more valuable than any individual outcome. Finally, understanding that each good trade builds the foundation for the next transforms the trader's approach to the market. Instead of seeking immediate gratification, reacting impulsively, or chasing profits, the trader develops a long-term perspective focused on cumulative growth and mastery. Every trade becomes part of a deliberate practice aimed at refining skill, strengthening discipline, and enhancing decision-making under uncertainty. The market is no longer a source of anxiety or emotional turbulence, but a field of structured opportunities in which each disciplined action contributes to ongoing development, creating a self-reinforcing cycle of skill acquisition, psychological resilience, and consistent performance. In trading, the most common misconception is that success comes from intensity. The idea that working harder, analyzing more charts, or taking more trades will automatically lead to better results. While effort is necessary, intensity without consistency is often counterproductive. The market is unpredictable and probabilistic, and the trader who relies solely on bursts of effort or emotional drive is likely to experience inconsistent results, stress, and frustration. Mastery in trading, as in any skill-based endeavor, is the product of consistent disciplined practice over time. It is the repeated execution of well-defined processes, rules, and strategies that produces sustainable results. Intensity alone may produce occasional big wins, but it cannot create the reliable performance needed for long-term success. Consistency is a mindset, a habit, and a discipline. It requires the trader to approach the market with the same level of preparation, adherence to strategy, and emotional control in every trade, regardless of the circumstances. Each trade is treated as an opportunity to execute the process correctly, not as a chance to chase results or prove one's skill. This mindset creates stability, allowing the trader to make rational decisions under pressure. When consistency is maintained, the outcomes, while still probabilistic, begin to align with expectations over time. The law of large numbers comes into play, and the trader can evaluate performance based on statistical validity rather than short-term variance. Intensity without consistency, on the other hand, produces erratic behavior, overtrading, and a reliance on luck, which leads to mental and financial instability. A key aspect of consistency is adherence to rules. Every successful trading strategy is built on a set of rules for entry, exit, risk management, and position sizing. The trader must follow these rules rigorously, trade after trade, without deviation. Emotional impulses, overconfidence, or the desire to capitalize on market noise must be subordinated to the system. Consistency ensures that the trader is not influenced by the outcome of previous trades or by short-term market fluctuations. This disciplined execution is what separates professional traders from amateurs. While intensity might lead to periods of high activity and engagement, it does not guarantee that decisions are being made in accordance with strategy. Only consistent adherence to rules produces reliable results over the long term. Consistency also fosters psychological stability, which is critical for mastering trading. Emotional responses to wins and losses can disrupt judgment, creating a cycle of impulsive behavior, overtrading, and self-doubt. By focusing on consistency, traders learn to detach from the outcomes of individual trades and concentrate on the quality of execution. This detachment reduces stress, enhances clarity, and strengthens decision-making under uncertainty. Over time, consistent practice develops resilience, allowing the trader to maintain composure during volatile markets and to respond to challenges with a calm, analytical approach. Intensity may amplify emotions, whereas consistency cultivates equilibrium, which is essential for long-term mastery. The process of developing consistency also involves patience. Markets do not always provide ideal setups, and opportunities must be evaluated according to pre-established criteria. The consistent trader understands that waiting for high-probability trades is preferable to chasing low-quality opportunities. This patience is not passive. It is an active commitment to the rules, to risk management, and to executing trades under favorable conditions. Over time, this approach reinforces skill development because each trade taken is a deliberate, well-considered decision, rather than a reaction to fear, greed, or boredom. Intensity may push a trader to act impulsively, but consistency teaches restraint, discipline, and strategic timing, all of which are fundamental to mastery. Another element of mastery through consistency is the compounding of learning. Each trade executed according to process provides feedback about the trader's strategy, risk management, and psychological responses. By consistently recording, reviewing, and analyzing trades, the trader develops an ever-expanding understanding of market behavior and personal decision-making tendencies. Errors are not catastrophes, but opportunities for refinement, and successes reinforce correct habits. Over time, the trader builds a deep, structured knowledge base that informs better decisions and reduces reliance on intuition or guesswork. Intensity alone cannot produce this level of insight because sporadic effort does not provide a reliable dataset or experiential learning that can be systematically analyzed. Consistency also directly influences risk control. Trading is inherently uncertain, and outcomes cannot be predicted with certainty. By consistently applying risk management principles, including position sizing, stop-loss placement, and diversification, the trader preserves capital and maintains the ability to participate in future opportunities. Intensity, when applied without consistency, often leads to over-leveraging, emotional overreaction, and a disregard for rules, which can result in catastrophic losses. Consistency ensures that risk is controlled, mistakes are limited, and long-term survival in the market is possible. It is the combination of disciplined execution and controlled exposure that allows mastery to emerge over time. Furthermore, consistency reinforces confidence and self-trust. The trader who reliably follows a well-defined process develops faith in their ability to make sound decisions, regardless of short-term results. This confidence is not dependent on luck, intuition, or the occasional big win. It is grounded in repeated, disciplined execution. Intensity-driven traders may experience bursts of confidence after profitable streaks, but these are often fragile and dependent on external validation. Consistent execution builds durable confidence because it demonstrates that success is a function of skill, preparation, and disciplined behavior rather than chance. Consistency also improves adaptability. Markets are dynamic and conditions change constantly. A trader who has developed a strong foundation of consistent process execution can adapt to new situations without abandoning principles. They can adjust strategy, manage risk, and respond to evolving market behavior with clarity and control. This adaptability is a hallmark of mastery because it allows the trader to thrive in uncertainty. Intensity-driven approaches, by contrast, often lead to reactive, short-term behavior that lacks structure and is vulnerable to unexpected market movements. The discipline framework created by consistency enables the trader to navigate complexity effectively and to make reasoned adjustments while maintaining control. Finally, mastery through consistency is cumulative. Each correctly executed trade contributes to a foundation of skill, confidence, and resilience that supports future performance. The compounding effect of repeated, disciplined actions results in incremental but sustained improvement over time. Intensity may produce short-term spikes in activity or performance, but it does not create the lasting framework needed for long-term success. Mastery is the result of incremental progress, deliberate practice, and unwavering adherence to process, demonstrating that the true path to trading excellence is built on consistency, not bursts of intensity.